All right, all right. Good morning, good morning. It's another great day in the stock market. How are you guys today? It's nice to see everybody. We're going to learn three things today. We're going to learn the difference between long shares. We're going to learn the difference between a leap, deep in the money, long call, and we're going to learn a synthetic long. It's the synthetic long that we're going to have fun with. All right. I like the synthetic long, but it's got its advantages and it's got its disadvantages. I'm not a big fan of deep in the money leaps, which is kind of what they call the strategy that we use for um, the strategy that we use for poor man's covered call. Not real fond of them, but they're real popular. A lot of people like them, so maybe you'll like them. I'll show you how to do one, and then I'll show you something that I like better. All right. So get out your tea and let's start looking at the markets. All right. First thing up is Apple. This is our portfolio, and we're in a little bit of a drawdown on some of these stocks. So we're going to have to go take a look at them and see if we need to make some adjustments. We've gone through, and in past classes, we kind of played around with Apple. We've kind of come in here and played around with the Fibonacci projections going into the next leg of the Darvis box, right? So that's what we're looking at here. Let me bring me down here and we'll see if we can make this larger. And that's what we have right up here now. So we're a huge extension of Apple going up. And that's really cool because we have some Apple and we're happy to see Apple rise like this. We've been watching Apple languish for the last 6 months and finally is starting to push a little higher. And so we broke the previous high, took us into the next Darvis box, and away we go. Now, it has quite an extension on here. So I thought this would be a good opportunity for us as this market pushed higher up into here to show you how to put on a synthetic short position. What's a synthetic short position, Lan? Well, if you don't want to, outright sell the shares and take a short position, and you want more of just kind of a hedge against the short side in case the market flushes and falls back down, test this previous low down here. Because we know markets don't go straight up, right? Well, sometimes they do, but markets don't generally just keep going straight up to the moon and never turn around and come back and have a little pullback. So because we expect or anticipate a small pullback, we could protect ourselves in a number of different ways. Well, first of all, we could protect ourselves if we're long, and we're not long in this one. I just want to demonstrate a a way of protecting yourself to the downside and actually make a little bit of money if the market actually does want to fall. So this is a synthetic short position. And what we've done here is we have the way you put on a synthetic short position. Let's come in here and I'll bring in my positions chart only. You can see what we did is we sold a call and we bought a put. So we sold a call and we bought a put. So if you sell a call, that gives you premium, right? So we collected $440. Of course, that $440 will have to decay away and we'll have to get it over a period of time. Now, of course, they give it to you right up front, so you have to give some back if it doesn't all go in your favor. Then we bought a put. Now, in this case, the put cost us more money than we received on the call. That's because the market's very extended and the market felt like the put should be more expensive because there's a higher likelihood the market could fall out of this big, huge extension. So we had to pay $675 for the put. So there's a bit of a put skew in there is what they call that. We call that a skew because of the difference. There should, if they're right on top of each other, which these are, they're both the 250 puts and calls, they should be the same price, right? But because we have a market sentiment and the market thinks, hey, it's more likely the market is going to fall, we're going to charge you more money for the put. All right. Well, that was a pretty big skew, $675 for the put. And the $440 for the call didn't quite pay for it. So there was a cost of doing business in there. A couple $100 we had to pay for that, $235. Now, this is a synthetic short position. It acts as if you are short the market. And it's just a hedge we're going to put up there. And it's down $310 right now because the market exploded again this morning and started to rally against that position. So it's acting as if it is it's acting as if it is a short position, as if we sold 100 shares. All right. But it's not 100 shares. We're not actually short 100 shares, it's an option strategy. So you can put that on there and you can use that as a hedge against a falling market. That's what that is. That's a synthetic short position. Now we're going to go put on some synthetic long positions, and I'll show you the advantages of those as well. So this is kind of doing a little bit of Fibonacci work in here off of this next Darvas box. And so this is our next Darvas box out here. And of course, a Darvas box is basically one Elliott wave. All right. So you have an Elliott wave in here, you have a previous high, you have a previous low, and then where the Elliott wave comes in, and then where it breaks above the previous high, moves into the next section or the next rally point, and that's how markets advance through price and time, right? They go up through Darvas boxes. We call them Darvas boxes because a guy named Darvas wrote a book about them, and so that's why we name them Darvas boxes. And so that's how that got that name. So you go from one box to the next, and then the market kind of, it feels like it's going sideways, but it's really kind of moving its way through the Elliott wave. And then when it pops out the top, creates a new Darvas box. Now, we don't know how big this Darvas box is going to be. We just can make guesstimates at it, right? But what we do is we just take the previous Darvas box and say, well, the last one was this size. Past performance is not necessarily indicative of future results, but it's the best we got. So we take this previous Darvas box, we draw a box the same size, and we come up here and we say, well, if it were to do the same thing again this time, this is where we could work. So then you can make your projections of where you think markets might be over a period of, of time. If you think the market's going to continue to rise, basically like it has been doing. So we do expect this market to rise, but we also expect it to flush and come back down, give a little bit back, have some profit taking before it goes up into the next drive. So this would be drive one right here, right? And an Elliott wave is drive one, and Elliott wave second drive would be drive two, and then Elliott wave third drive would be drive three. And then we would look for a little break, come back down like this, and then back up and go into the next Darvas box. All right. And then that's how markets move through price and time over a period of years. And these are daily charts. So these are months at a time or years at a time. So this Darvas box right here is 1, 2, 3, 4. It's almost 5 months long. It's 4.5 months long, which was the same distance as the last Darvas box. All right. I don't think we went back and did the previous Darvas box, but it was one big long Elliott wave right there. That was a big Elliott wave. So look at this one here. We come in here and we draw a Darvas box from this high here to this low here, and it broke right there. And that's where it broke out of that Darvas box. So you can see there's a Darvas box right there. So that is the breaking of this Darvas box. So if we come in here and put that in there, that's how big that Darvas box was. And then it broke out and took off and went up there like that. You could almost, come back and draw this Darvas box all the way back here like that. That's how that should actually be done. I started it from the top to the bottom and went out, but this is actually from the previous Darvas box. You can see that's technically speaking where it would be. Now, let's take this Darvas box and measure it against that Darvas box. How good of an estimate were we? Well, see, it took a little bit longer to get through this Darvas box than it did that one. Okay, well, let's put that back where it belongs. We'll put that back here. Now we got this Darvas box that the market went through, and it went into that Darvas box. That makes this Darvas box longer. Does that mean we want to come in here and make this one longer? No, for right now, I think we're good. We'll just leave that Darvas box where it's at. Where the ending is, we'll find out when the market gets there. But for now, we're just looking for this market to continue to rally and up through that next Darvas box. And that's the whole idea and the concept of what we're trying to do here, is just to make our very best swag, right? Our very best scientific wild ass guess of where we think the market's going to go. We have no idea where the market's going to go. Nobody does. But we can do scientific wild ass guesses, right? So that's what I call them, is swags. Scientific wild ass guess, because that's what we're doing. We're just making a wild ass guess. And then we can use these mathematical models like the chalk and money flow, the MACD. I like to use the average true range. I've got in here Fibonacci. This is actually set up to be more like a Fibonacci ruler. It's actually the Donchian channel. And so I use that to kind of give me a heads up of where Fibonacci would be drawn in here. And I just use that as a as a guide so that I don't have to constantly be drawing my Fibonacci rulers. And I know it's not perfect. You can redraw and put your manual Fibonacci rulers in there and get a more precise a precise reading off of the market if you feel like you need to. But right now we're good right here with this one breaking higher, and we're just looking for it to come back and test this previous high and create what we call a Fibonacci bow tie, right? Fibonacci bow tie. That's this high here, comes down, rallies up. Where's that going to go? Well, we generally look for it to go up to 161.8, or even this is pushing up into that 200 level. and then we look for it to come back down and test that previous high, which is back here, and that gives us that little bow tie right there. All right. So areas of resistance, which is what this was here as it broke that previous high, becomes support back in here as it comes back down and tests it. So that a lot of people like to get in on a break above a previous high, which is what this would be right here. A lot of people get in right there only to have the market push up and they're all happy, happy, happy. And then it turns around and it comes back down and it tests that previous low. And that's why it does that, because there's a lot of people who got in there, comes back down to that level, takes all their stops out, turns around and takes off and goes without them again. Ever had that happen? Well, that's a Fibonacci bow tie. That's why that pattern occurs, is oftentimes is because it's coming down, taking out all the stops of the people who got in on a break above the previous high. That's why I like to buy the dips, buy the valleys down in here. This is where I'm more likely to want to get in, so that if it does come back and stop here, it doesn't take me completely out of the market. All right. So now we can put our hedge in up here if we have a long position from down here. And that way, if the market comes back down, well, we're hedged a little bit and we can take a little bit of a drawdown and not have our heinies handed to us off of our long position, right? It's just a way of putting a little hedge on there. Of course, if the market continues to rise, your hedge, loses money too at about the same rate as your long position. Of course, in here, we took our long position off already, so we don't have a long position. So I just thought I'd show you that little hedge strategy in there, and that's what that is sitting there. And that is a quick lesson in Apple and the Darvas box, the Fibonacci projections, and where we anticipate markets moving through price and time going into the future. That's how you do, read your tea leaves. Speaking of tea leaves. All right, let's go in and do some more work. Let's go to the Airbnb. Airbnb, I bought a little Airbnb. Yes, sir, I did. And I am anticipating this market taking off and continuing to rise. We've already come back into the X1S A1. This is an A2 right in here. It's not very pretty. The market's going sideways, but it is on a rise. All right, let's draw a little trend line in here. We'll just see where that natural trend line came right up through there. It respected it pretty darn well. You have to admit that market did a pretty good job of respecting that natural trend line up through there. All right, it did break, came down, give us a little ABC, and then the ABC downside to the Fibonacci ruler. Well, it was so weak, it hit the Fibonacci ruler at the first. I thought we might get a little bit further pull back down into here. And so that's why we sold this option down here, saying, well, if we get a full ABC projection level down in here, we could easily see this market back down in this region. And so we sold a put down there in anticipation of buying some shares down there. But since it started to rally right in here, we got long the shares right here at this A2. It's not really an A2 because it didn't break the little yellow dots. It needs to break the yellow dots, flip the dots to the other side, and then it's an A2. But we're going to call it an A2 that's actually still part of the A1. I was thinking I said B2. So this is an A2. That's exactly what this is. Not B. It's not a B1 yet. It's got to break the lights to be the B1. So we're still in an A2 strategy. Now, X1SA1 is a very low probability of success, and I've got my hiney handed to me many times trying to get in on X1SA1s. You think the market's going to come down off this Elliott wave pattern and take off and start to go again, only to have it go up and flush back down. A1S is like a pair of twos. It's not a very good, not that the market can't go and make you money. It's just real low probability of success. And I've actually proved that out many times myself, thinking I was going to make all kinds of money on an X1SA1, and I got my hiney handed to me. So not the best probability. So we are, though, going into an A2 here, and the market is starting to rally, so we can't complain too much about this strategy right now. And that's what we're looking at there. Not a lot more to talk about. We're going to draw another trend line in here. If it stays above this trend line, we got our nice little ABC pattern. If it respects that trend line, as long as it stays above that trend line, we can stay in this market. All right. I hate to see it fall below this first natural trend line, like this one here. See this nice big beautiful green trend line? As long as it stays above it, we're happy. I hate it when when the market falls below that trend line. Respects it nicely and then it falls below it. When it falls below it, that's usually sign to this trend is weakening, but as long as it stays above it, and we generally get 3 drives, right? We call that the 3-drive pattern, or it's basically an Elliott wave. So 3 drives is an Elliott wave. So there's your drive 1, and then we come in and we get a drive 2, and this one went up here, created a high there, another one there, and then we got another little drive up in here, and then it came down, and that's where it broke. So that's pretty typical. The 3-drive pattern, Elliott wave pattern, and then the ABC pattern. So that's what we look for. And if a market's not doing that, well, don't trade it. So this is kind of what we look for. Now, where's the Darvas box come into play, Lan? Where's the Darvas box? Well, the Darvas box is the Elliott wave. So if you come in here from this low right down in here, we're going to draw our Darvas box from here to the high, which is up in here. And then the Darvas box is going to stay there. It's going to stay in the Darvas box until it breaks above the previous high of the Darvas box, which is this price here. So it's got to break above there to get out of the Darvas box. Okay. Now you can see back here, if you go back and say, well, where was the previous Darvas box? Well, it was coming down. So you have to do Darvas boxes on the downside. So the low to the high, back to the low. You could almost say that the Darvas box was like right in here somewhere. I don't know. Let's draw this. Harder to draw them from the upside to the downside. It's easier for us to see things from one side to the other. So something like that, right? So that looks like the previous Darvas box right in there somewhere. So let's call that our Darvas box, previous Darvas box. So this is our next Darvas box here. It's just going sideways again. It's not really going up. So we need to see this thing go up and break above this previous high and continue to rally. Come on, Airbnb. I do a little Airbnb, and I have my little condo down here in St. George. And when I'm back up at my house in Logan, I rent out my condo as an Airbnb. Now we don't know where this is going to be, how long this Darvas box is going to be. How long is it going to stay in this box? We don't know. So that's just an expiration of the option. We got an option right here that's going to pay off for us, it looks like. And it's up $77. And there's nothing left in it. $89 is the max. I don't think we're going to get our shares. We're going to go ahead and just kill this one. While we're here, let's just take our profits off. We've hit max profit. There's everything to lose and nothing to gain. And I don't think we're going to get our shares, so we just take that off. And it's better than a stick in the eye. We didn't get our shares, but we could put on a this might be a good opportunity to put on a synthetic long position. So let me show you how to do that. Synthetic long means, well, let's talk about the different methods. We could come in here and first of all, we could say, well, we're bullish on this market. We think it's going to go up. We think it's going to stay above the natural green line. We think we're going to get a new Darvas box eventually. Let's create a new Darvas box. So we're going to come in here. We'll just draw one just like this one here. Again, past performance not necessarily indicative of future results, but it's the best we got. So we're going to come in here. We're just going to make a swag, a scientific wild-ass guess that this might be where this new Darvas box ends up, right? And we'll adjust it as it moves. We can always make adjustments. And so we're going to come in here and anticipate that the market's going to move up through this Darvas box. Now, if that's the case, we're bullish this market, there's a number of ways we can get long this market and start making some money, right? We missed out on the opportunity to pick up some shares down in here, which is what we tried to do. So the market's going without us. It doesn't mean it can't turn and fall again. Certainly can, but we're bullish on this market. We think it's going to go to the next Darvas box. So there's several things we can do. First of all, we can just come in here and buy 100 shares. Boom. There you go. You're long the market. Happy? All right. That's great and wonderful. We can come in here, go into the options, and we could say, well, we're going to go out and we're going to do 37 days, and we're going to sell a call up here, and we're going to collect a little extra premium up here as it breaks up into this above this previous high. There you go. All right. So that's a great little strategy. You're going to capture the difference between where the market's currently trading on 100 shares up to the covered call. You'll make $1,000 on the long position. The covered call is going to give you $178. That's just a traditional covered call. All right. You long the market, sell an option, collect some premium as the market starts to rise. What if the market doesn't rise, Lan? Well, you collect the 178.50, and then you do it again, and 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 you do it again. You get rich, rich, rich beyond your wildest dreams. It's just a process of buying and selling covered calls. All you're doing is just saying, I'm going to buy the shares here, and I'm going to sell them there. And to make that promise that you're going to sell them there, they give you $175 to do that. And that's called a covered call. All right, so let's cancel that. And let's kill these shares. We're going to take those shares back off. Now, I'm losing my voice. Hold on a second. Hold on. Let me drink some tea. All right, let's see if that works. See if that helps out. A little hot tea. All right, so where did we get to? Now we're going to put on let's put on a poor man's covered call. All right. A poor man's covered call is when you come in here and you say, well, I think over the long haul, over the next year, this market's going to go up. So you come in here and you go down to your options chain and you say, let's go down to, I don't know, 282 days out. Okay, that sounds good. 282 days out. We're going to come down here where all the volume open interest is. Actually, we need the calls. We're going to do a call and we're going to come down here. Oh my goodness, we can't do it on the Airbnb. There ain't nobody playing in that sandbox. Let's go see if there's a little shorter one. 247. Nope. Well, that one's not too bad. 219. That's worse. 191. Oh, that's not too bad. That's only 191 days. Okay, it's all right. We'll do that one. Well, let's see. Yeah, we can do this one. We'll just do this one. We're going to come down for a delta. Now, there's a lot of people who like to do delta 90s on these. Way down here deep in the money, you can see that's $5,695. And delta 90 means that the stock or the option, the long call option, will make or lose as much money as 90 shares. That's deep in the money, long time to expiration. We call them leaps. I call them long-term equity opportunities. All right, leaps. So it's just a long-term call option, but you put it deep in the money so that you can mimic basically having the shares at that price. But you have to pay $5,695 to do it. Of course, if you were to buy 100 shares, you'd have to pay $13,882 to do it right here at the current price. So $5,695 is a lot less than $13,882, and you get basically the same result, right? You get a delta of 0.90, which means you're going to make 90 cents for every dollar that the underlying 100 shares would make. If we put that on, that would be a leap, long-term equity opportunity. It's just a long call with 191 days till expiration, costs you $5,600. Then you have this position in the market. If the market goes up, you make money, but it's a call option. So it has to go up. It has to make money. Because if the market doesn't go up, you lose money on calls, right? You need it to kind of be a little bit explosive, but you've got a lot of time. You got 191 days. And in the meantime, you can sell covered calls against it, just like you can 100 shares of stock. So that's pretty cool. And that lowers the cost, brings that $5,695 down. Well, there's other ways that you can bring down the cost, the $5,695. Can you see that over there? Let me get out of the way. How do I move me? Here we go. So see this down here, $5,695 right here, down here in the left corner. That's the premium. All right. So $5,695, what you're paying for it. Now look at the spread on this thing. It's $160. So it's going to cost you $160 to get in. That's a nasty spread. And that's what I was looking at. And the open interest on here is very low. That's why the spread is so high. This has got a little bit higher. You can see it's 95, but the delta is 89. Now, a lot of people like to go in a little bit higher. They like to go in up here to delta of maybe 70. Look at this. Now, a delta of 70, there's no volume on that today, but there's 351 open volume, and the spread is only $65, and the cost is only $2,387. Well, that's one way of lowering the cost of your entry, right? Oh, that's a great idea, Lan. It was 5,000. Now we're only looking at 2,000. But the problem is the delta is 0.70, meaning it's only going to make 70 cents instead of 90 cents for every dollar that the market moves. You can look at delta as the number of shares that an option is trading. So this option, this 125 call, is trading 71 shares. It's representing 71 shares. Okay, so you make as much or lose as much as you have in the delta. Now, as the market moves further away from your position or in the money, right, intrinsic value, that delta will increase. So that delta will move down from 70 to 75, 80, 80 back down to 90, and then you'll be making 90 cents for every dollar that the underlying market is making. So you can start at 70, and if the market rises, what we call convexity, right? Convexity is a word that says that delta moves between 100 negative to 100 positive, and then your delta is going to go up, which makes you more money. And then if the market turns and starts to fall down, delta will go back down, and you will lose money more slowly. That's kind of cool. So with options, because of convexity and delta going up and down between negative and positive numbers, as the market rises in your favor, delta goes up. Therefore, you start making money more quickly as markets rise in your favor. And if the market starts to come down, delta will start to fall, and you'll start losing money more slowly. I think that's a pretty cool feature from options. All right. The problem is, though, is that this market has a $2,387 barrier that it has to overcome by expiration, right? And expiration is still 191 days, even though, it's the same as the $5,000 one that we put in there, but it's all on a delta curve. So it doesn't really matter which one you grab because it's going to be the same. There's less cost, but you make less money. There's more cost, but you make more money. So it's that delta curve that we always talk about. Do I need to go pull it up? Let's go pull it up real quick. Let's see if I can find it real fast. So the point is that it doesn't really matter which one of these you choose. I mean, it's got some small advantages one way or the other, but for the most part, it doesn't. That's the wrong delta curve. This one here. All right. So the market likes to go through this, what I call the delta cone of probability. And that's what we were just talking about, right? Where the market is actually the real term for it is empirical data distribution rule. I just renamed it delta cone of probability because it's easier to say. All right. So if you want to go do a little bit of extra research, go pull up your Chat GPT or go pull up Google and look into it. Look into the 68, 95, 99.7 empirical data distribution rule, because that's what we're talking about. For me, I just call it the delta cone of probability. If you search delta cone of probability, you probably won't find anything because that's just my name for it. All right. But approximately 68.2% of the markets stay within a standard deviation. It likes to stay inside this one standard deviation. 94.5% falls within 2 standard deviations, and nearly 99.7% it goes out to 3 standard deviations. So you can see the market likes to stay inside these standard deviations, and that's what that's really talking about. But that delta cone, you see how that delta cone works? That is what we're working with here when we call the delta, and that's the convexity of the market moving back and forth between that delta cone. All right. I know sometimes that gets a little bit hairy, but that's what we're working with. We're working with a delta cone. And if you want to think about it like that, and we talk about Darvas boxes, each Darvas box is a delta cone. All right. So as we come in here, you're going to go from top to bottom of the Darvas box and think about the delta cone like that. All right. So that's your delta cone, and the market likes to stay within that delta cone of probability. That's why we have a Fibonacci ruler that we draw from top to bottom. And you'll notice that there's what I call the Fibonacci sweet spot, which is right here between 61.8 and 38.2. And oh my gosh, look at that. It's dead center of the delta cone of probability. All right. So that's why we have a Fibonacci ruler. It's based on the delta cone of probability, and it's based on that theory. And that's why we think the market oftentimes will return to, or likes to spend a lot of time through that Darvas box inside that delta cone of probability, or inside of that 1 standard deviation right there around 50% level. So it goes into it, it kind of wanders through it, goes up, breaks above it, likes to come back down into it again before it turns and goes again and goes to the next Darvas box or the next Fibonacci projection ruler, right? That's why we have a Fibonacci ruler. It's because it is the cone of probability. It's the delta cone of probability. All right. So now you understand a little bit more about what all this happens and how we have Elliott waves, we have Fibonacci rulers, which are delta cones of probability, and we have moved through price and time from one Darvas box to the next Darvas box, and each one of those 3 drive patterns inside of each Darvas box is called an Elliott wave. So it all comes together as one simple package used to try and use probabilities to predict market direction. Does it always work? No, of course not. It's just a probability statement. So, but that's how you're going to do the best, make the best, you know, swag, scientific wild ass guesses at where a market's going to go. And then I use all these little A drives, B drives, and C drives to kind of help us know where we're at in the 3-drive pattern of an Elliott wave as we go through price and time. And that's what we're doing here. It's just a real simple process. You just kind of, once you learn it, it's not that hard. And you just realize you're just going to do the same thing over and over and over and over and over again on different stocks. That's all there is to trading. All right. And then we just use different strategies to take advantage of it, whether that's going to be a long call, whether we're going to just get in with shares, whether we're going to use a poor man's covered call or a synthetic long position or a synthetic short position. We could just play these different patterns as they go through price and time because we understand what the probabilities are, and we're just going to play the probabilities. And that's all there is to it. Okay. Pretty simple. And if you don't understand that, you're like, man, Lan, did you write this down for me? Because this is really great stuff. Where would I find this written down? Well, I've written it all down in a little book called The Stock Market Playbook of Strategies. And you can go get it out on Amazon. Just search Lan H. Turner. Make sure you get the one with the little chess pieces on the front, because there's 2 or 3 versions I've had out there. This is the most recent version, and that's the latest version. And get the right one, because there's several guys who have got the wrong one. This is the one you want. It's the latest and greatest version, and it's got a lot of stuff in there. It's 280 pages of how to do all this stuff, and it's not a book like you're going to read. You know, it's not a novel. This isn't a novel. It's a workbook. It has lots of graphs and charts, and it has lots of examples and lots of, you know, tables and showing you how to do all this stuff. So go get that. It's your manual for the class, and it's not very expensive, like $35. It's 280 pages. Amazon makes all the money on it. I don't make any money on it. I haven't made a dime on that damn thing. I just put it out there. Amazon makes all the money because they have to print it and ship it to you and all that kind of stuff. And so $35 is about as much as we can make on it, much as we charge for it. And that's what Amazon charges for it. So there you go. Go get the book. That's the manual to the class, and that's what we do here. All right, there we go. Oh, we got to go in and we got to do which one should we, were we going to do this one? This one, we're going to do this $2,347 long call. So we're going to buy that right there. See that? And that's right there at about Delta 70. And so if we do that, we come in here, let's go ahead and put it on. We're going to go in and buy that. All right. So we just paid $65 to get into that damn thing because the spread is $65, but it goes 191 days. That's kind of the way the cookie crumbles. We have 0 volume, which is not uncommon for leaps, but at least we have some open interest, $351. I like to see those a little higher, but oftentimes on these leaps, you don't get them that high because there's not a lot of people playing leaps. All right. So anyway, especially on Airbnb. So now we got a long position here. The thing is we paid $2,347 for it. So one way to help us pay for this and to lower the cost is to sell a covered call. And we do that just like we would any other covered call. We got a long position here. We come in here and we go sell a call, and we drop that. Call against that covered call, all right, or that long call right there. So we're going to keep the long call. Notice 191 days. This covered call is only 37 days. We're going to collect $163. Well, that lowers our cost, right? Because what did we pay for that call? We paid $2,380. And every 37 days, I can put another covered call in there and drop the cost of that down by 165, and that lowers the cost of my long position. And over time, of course, we anticipate or hope that that market continues to rise up into that next Darvas box. And before our long poor man's covered call is what that is, that poor man's covered call expires up in here. See that? Now, if it comes up in here, by the time it expires, well, where is that expiration? It's way out there. We'll probably have two Darvas boxes by the time that leap comes into play, right? So if we say, well, if we have another Darvas box, this Darvas box here, and then we can say another Darvas box out in here. So by the time that leap expires way out here at this time, we might be up into the second Darvas box, making all kinds of money off of our long leap. And the whole time being selling covered calls against it, we'll be rich, rich, rich beyond our wildest dreams. All right. That's how that works. So that's a poor man's covered call. And you can see that the process of that one is basically the same as just a normal call. But rather than having to spend $13,000 to buy 100 shares, you can just put on a long call like that and only spend, in this case, we only spent $2,380, which is a lot less. And you make basically the same amount of money. All right. Because this long call will go to 100 delta at expiration. And if it's way up here, well, bully for you. You just made a ton of money. Problem is, what if it goes way down here? Well, if it drops and goes all the way down here, one of the advantages of a call option, right, is the max amount of money you can lose is $2,380. That's why people like call options, is because there's unlimited profit potential, and the max amount of money you can lose is the premium you paid. So by going to a delta of 70, you've significantly reduced the amount of money that you can lose, which in this case is $2,380. And you can see this is kind of your little area of support right in here. As long as it stays above that, you're going to be, at least you're going to be not, well, if it drops from where the market's currently trading when you put it on, that's where you're going to start losing money. But if it rises, well, it's got to rise fast enough to outperform the theta decay, right? Because this is a deteriorating asset the minute you buy it. So you could lose $2,380 if the market just simply went sideways from here all the way out and never did go up. You could still lose your full $2,300. But $2,300, a lot less than $5,000 from a covered call if you put it clear down at delta 90. And you have less to cover, so you do covered calls against it. You can collect $163 every 37 days. And in that case, it's a lot easier to cover $2,380. And if you were going to do one with $5,000 with a higher delta, well, you're still only going to be able to sell covered calls at 163. So it skews it a little bit in your favor by doing a little bit higher or a little bit lower delta, less money you have to pay. The delta is a little bit lower. You're not going to make as much if the market goes, but convexity will push that down to 90 if it does actually go. And your call options are going to be the same, whether you're trying to pay off a $5,000 debt or a $2,000 debt. And it's easier to pay off a $2,000 debt than it is a $5,000 debt using covered calls. And that reduces the cost of that option, and the option goes up. You make more money. There you go. So there's your advantages and disadvantages of doing deep in the money versus kind of a delta 70. Could I put it right at the money, Lan? You could. You have to be pretty confident that the market's just going to go straight up from there. You wouldn't want to have a drawdown, but you could, and you could put it right at the money and buy a leap right at the money. There's nothing wrong with that. There's some people do it. Delta is 0.50 instead of 0.70. So you're going to, you need the market to move. But again, you're going to have less cost, and your call options are going to pay off at the same rate as if they were trying to pay off a $5,000 option. Either way. So there you go. You can skew it in your favor one way or the other. I kind of like delta 70, 80. 80 is really popular, commonplace too. Just kind of work it out if you want to do the poor man's covered call. Let's go ahead and we'll just put this one on as an example. We'll go ahead and see if we can get that call option to go in there. We waited too long. Let's come in here and we'll place that again. We're going to come in here and we're going to sell our call option, sell a call right up here. We'll go ahead and $167. Let's mark it into that. See if it'll let me mark it in. There we go. All right. So now we got ourselves a call option on a poor man's covered call. So we'll let that one play through, and we'll go to the next one and we'll put on what I call a synthetic long. All right. Oh, this is AMD. Well, let's look what's going on here with AMD. AMD. This is on a downtrend. So we're going to go from this Darvas box down to this one, and it broke out that Darvas box way out here. And then it went back into the Darvas box. Look at that. It went back into it. And it went way back up in there. But this one came and broke out right here. So we're going to start a new Darvas box right there. Now this Darvas box didn't keep going down. It turned and started to go back up. So we're going to go like this with this Darvas box. So we're going to say from this, we're going to start here. We're going to go from this low to this high, and we're going to draw that out there. How long is it going to be? We don't know. It's got to break out this previous low or the previous high to get into the next Darvas box one way or the other. It looks like it's going to come down. Might just test that low again. And this is where we were like, well, you know what? This market's been coming down. AMD's actually, we went out and looked at this last time. The fundamentals are really good on AMD. They're making money. They're not buying back their shares. They've got cash. Everything is positive about AMD. They got a big government contract. I can't understand this. They got a big, was it government? No, I don't think it was government contract. They got a big contract from, who was it? Can any of you remember? I can't remember. Was it Google or Apple? Somebody gave them a big contract. And the market flushed. So I don't know. This is kind of weird. I put a couple of put options down here in anticipation that we could get filled down here and take some long positions. We get a couple shares, a couple hundred shares on AMD. It's $12,000 per 100 shares. So we're going to be 24 grand into this thing. We got one of them. We got two of them. One's at 9 days. One's at 37 days. This one here is 9 days. It hasn't touched it yet. So we'll have to wait and see. We might get some shares here, which I don't know if that would be such a bad thing. AMD is, it's been as low as clear down here. Look at this 200 period moving average down in here. We're going to draw a line across there. Where did that go to? So that is the low point. It's been as low as this. So this is a bad target. We don't want to see it go down to there. We'd have to roll these down. We'll let these ride for just a minute. See, we might have to roll them down. I don't know if I want to pick up shares at that level. Well, we could. We could buy our shares at that level, and then we... I don't know if I want to do that either. Instead of a covered call, you could do a covered put, because we'd be, well, no, this would be long. So we would start selling some covered calls against these long positions. There wouldn't be much money in them, but we could do it. We'll just play it out, all right? Let's see what happens. Let's see if we get assigned on these shares. We may roll one out, but made 106 on that, $685 on that one because we sold it right at the money yesterday. So let's just kind of sit on AMD for now. There's not a lot for us to do. All right, here's another one. Here's Broadcom. Okay, Broadcom. Ooh, this is a nice one for our example. Now, the situation here with Broadcom is we received 590. We're up 510. We're kicking ass on Broadcom on both these options. Unfortunately, we didn't get assigned any shares. And it would have been nice to be, maybe we should have self-assigned right here, but we didn't. So let's come in and liquidate these, take our profits, because there's nothing left in them. Look, there's 80 bucks on this one. We could stay in that one for another few days. It's rallying. We could make another 80 bucks, but let's just take them off and I'll show you another strategy. All right, we're going to do a synthetic long position. Rather than just a long call at Delta 70 like we would do with a leap, we're going to do a synthetic long. All right, so we're going to take these off just to get them out of the way and take our profits because we're up nice on them. 510 on this one, 364 on that one. So we're going to come in here and I'm just going to exit chart options. We're going to say yes. And boom, boom, boom. There we go. We took those profits, closed those out, closed out $870 in profit. And we're going to come over here. And now I'm going to put on a synthetic long position. What is a synthetic long position, Lan? What if I wished that I would have got assigned right there at that red line and I didn't? And I'm like, damn, I wanted to have some shares right there. And now the market's way up there. How can I get assigned right there? Well, you can't get assigned right there, but you can put on a position right there. And we're going to come in here and we're going to go out like 100 days. We could even go out 100 and, well, 156 is a little long. 100's a little short. I like about 120 days. That one's not going to have any, it's not dark. It's not, oh, it's not bad. It's not bad. We could do something in here maybe, but I'd probably be happier with this is this Broadcom. Let's go out. We could do the 156. Let's see how. Oh, you know what? 156 is not even as good as the weeklies in here. What about 100? Yeah, 100 is where we should be. That's where everybody else is playing. Let's compare that 100 against the 127 again. Yeah, we got to go to 100. Okay, it is what it is. You got to do what they got. All right, so we're going to come in here and let's draw our Darvis box in here, first of all, from this peak to this low. We're going to come in here, and there's our Darvis box. Has it broke out of the Darvis box yet? Nope. It tried right up there at the top, but it didn't do it. So we haven't broken out of the Darvis box yet. Where's our natural trend line? Well, we got one that kind of goes across that 200 period moving average, which really isn't kind of playing very nice in the sandbox. We got another one. That's drive 1 hump, right? Drive 2 humps. And then it came down here, drive 3 and failed. This is actually going into another. Yeah, see, X3, we got that labeled already. So we're going into another Elliott wave. So we're going to take a line here, and that broke right there. We could take one up there too, just for kicks and giggles. That one went right up like that. So that's your spider web. The spider web, Lan, what the heck is a spider web? I heard you mention that once. Well, it's in the manual. Go read about the spider web. It's actually, if you want to know the official term for it, it's called the speed fan. But I call it the spider web because it's more fun, right? I like fun words. So go and read the manual about spider webs. But it's just areas of support coming off the same position, right? So we got the same area of, you've got the same point down here, and it's all about geometry, right? You guys learned geometry in high school. Now you're going to use your geometry. You're like, man, I took this geometry class in high school and I've never used it, not once. Well, now that you're trading the financial markets, you're going to use your geometry. All right. So this is called the speed fan, and it's areas of support across coming off of one point, and it's geometry. Okay. So it's like geometry is all based around the triangle, right? Lots of geometry goes off triangles, and triangles are very powerful 3-point tools. And that's why we use those in trading, because it helps us with our swag, our scientific wild ass guess. All right, we got another point right here that's very important. We're going to go off that same point right there, and we're going to come up and touch that point, and we're going to just draw that speed fan out there like that. So these are areas of support. All right. Now, if you want to really get into speed fans and areas of support, there's a guy named Gann. Some of you have probably heard of him. He did a lot of study on this. All right. So, and he created something called the Gann fan. And so the Gann fan is really all about speed fans. It's all about geometry. So if you're really into geometry and you love that kind of thing, go study Gann, all right, because you'll really like that. But we're going to it's beyond the scope of today's class. Well, it's basically the same thing that we're doing. Gann goes into a lot of the probabilities of trends and trend strength and all that kind of stuff using basically the speed fan. So using geometry. So if you like that kind of thing, you can keep it simple like I do with just the spider web, or you can go into Gann and you can get a little bit more sophisticated. Okay. So there's something for you fun to go do a little research. So here we go. We're coming back into what looks like a new A drive. So we're going to put in here a synthetic long. What's a synthetic long, Lan? Well, it's basically the same thing as a poor man's covered call, where you just come in here with a long-term call, right? So if we just came in here with a long-term call and you drop that in there, it's basically the same thing, right? We're sitting here at a delta of, in this case, would be a delta of 76, all right? So there's our delta 76 long-term call, and we can put that on there just like that, and that would be basically just recreating the poor man's covered call with 100 days out, and we'd go and sell a call against it, and we'd have $2,957 that we'd have to cover with our call. That's what that is, right? You're like, Lan, you haven't taught me anything new. Nope. Watch this cool trick. Now we're going to make it a synthetic long. So now we're going to come in here and we're going to sell a put option at the exact same price, right over the top of it, at the exact same price. Same day, same call, same put, same everything, right over the top of it. 100 days, the whole thing, you're just going to do the put side instead of the call side. If you put that on there, Lan, isn't that just going to liquidate the other one? Isn't that going to just offset it? Aren't you just getting in and getting out at the same time? Well, nope, not exactly. Because remember, when we go to class, and I always make you guys, I'm like, don't ever say sell options unless you're going to actually enter the market to sell. So see this over here on the right-hand side, you have this little thing, sell to open. You can sell an option, but you're going to get in with another one. All right. So if we're going to actually get rid of an option, we don't want it, we use the terminology liquidate, right? I want to liquidate my option. I want to get rid of it. That's what liquidate means. But if you sell an option, that means you want to open, you want to sell to open. That means you want to get into another one. Therefore, if you say, well, I'll sell me a call option, sell me a put option, well, you're going to get into the market. Okay. Oh, I had one. I wanted to get out. Well, you can do that. You can buy a call option, right? At, let's say at this 100-day, you could buy the call option, and then you're in it, and then you want to get out. Well, the way you get out is you would sell a call option at the exact same price, and then that would get you out. So you can buy and sell. You would buy to open, and then you would sell to close. All right, and that's in the little drop down over here. You can see it. They sell to close. Okay. When we drag and drop our orders on there, it sets that up for us automatically because Track and Trace smart. It knows what you're doing here. It knows what the rules are. And so it knows that what you're trying to do is sell to open because you told it up here we wanted to sell a put. So it knows that you want to sell to open. Okay. If you'd have said sell to call, we'd have sold to close. It would have known that because you told it right there. All right. So now what we're going to do is we've got a put and a call at the exact same strike price. We're going to buy one to open and we're going to sell one to open. So we're going to have two. We're going to have a call option and we're going to have a put option right at the exact same price. Now, what happens when you buy a call option? You have to pay the premium, right? The premium that we're paying here for this long call, just like we did with the poor man's covered call in the previous chart, is going to be $2,972.50. That's what we're going to pay. But when you sell a put, and we've been selling puts a lot. We do that, right? We know what selling a put means. It means we're going to collect premium at a certain level, and our risk is that we might get assigned the shares at that level, which would be fine with us. We don't mind having the shares at that level, right? So we're going to buy the shares at that level if we sell a put. But what happens when you sell a put? Well, you get to receive some premium. You get some shares. I mean, you get some money. They give you money to do that. So let's come in here and look at the puts. Now, the problem we've got here is they're not giving us nearly as much money on the put as what we're paying on the call. That's not fair. That's not fair. That skew is awful. That call option is really expensive and the put option is really cheap. So this might not be the very best place to do this right now because the market's taken off, which means that the market's going in the direction of the call, which means the call is really expensive. And it's not going in the direction of the put, so the put is very cheap. So by putting this on right now, we got a terrible skew. The difference between the put and the call, which should be relatively close, is way different. Look, we're only getting $637 for the put, but that's because we're way out of the money too. And we're getting $297 for the call, which is in the money. And the market's moving in our favor. So we got lots of things going against us. So we're buying an in the money. So the way we could solve that is not do it out here. We could come in here and we could do it right at the money and see if that doesn't solve that problem. There we go. We push it right up in there. Now we should be very close. All right. So we got a synthetic long right at the money. Not the best place to be buying. What is that? That's our A. Let's get rid of this for a second. Let's just send it to the back. See if we can send it back. All right. Let's look at this. This is A1 right here. This is X1. This is a A1. Ooh, that's an A2 right there, but it's just one little bar and one little bar. So this is, I hate it when that happens. We're not going to know for sure, but I think this here is going to be our A2 right here. And if this is A2 right here, then we got some additional upside potential. I think this market, Broadcom, this is kind of, see, we kind of usually, right, we get a little pullback and then a rally, but this is the little pullback right here. That might be it. That's all we get. It's one bar. So if we put our long, synthetic long right here at the money, I would rather have put it in at the break. This is buying close to the breakout of a previous high in anticipation of a previous high. But notice the cost. You're going to pay $142. And it's going to act as if it is 100 shares long. That's how that works. All right. So if we put that on right at the money, it's only going to cost us $142. Now, we could have done it down here like our poor man's covered call, and the skew between those two, you're going to pay $645 against the 293. So it's significantly reducing the cost of our poor man's covered call by selling a put over the top of it. See that? That's pretty cool, right? Now, when we do our covered calls up in here and sell our covered calls, we don't have to cover an additional $645 because we covered them with a put. So that's a way of reducing the cost of your poor man's covered call by doing it this way. But we're going to do it at the money and do a synthetic long. And what's going to happen is we're going to do it right over the top of each other. So we're going to pay 1,665 for the call, and we're going to do 1,562 for the put. Basically, it's not quite a free trade, but almost. We're only going to have to pay $103 for this, which is why you can see that it's down here. Much better than paying $16,522 for 100 shares, and it's going to act like 100 shares because you got a delta 50 of the put and a delta 50 of the call. Makes 100 delta. All right. So now if we come in here, that's breaking on the A2. I'm just worried that we're going to put this on only to have the market flush back down a little bit. Take some profits. We're trying to get out of this Darvis box. We're staying above these trend lines. We got this trend line here. This could be a resistance point up in there. We got to keep that in mind. Anyway, we're getting long right here. So let's go ahead and do that. We'll just do it. We're going to come in here. If I was going to do it with real money, I might wait a little bit, but this is a lesson. We got to put it on. So we're going to come in here and we're going to market this thing in. So now we bought and we sold right at the same money. So now we got a cost of doing business. Our position cost us $125. That's all it costs us to put on a long position right here at the money, and it's going to act just like we have 100 shares. Isn't that cool? That's cool. So this is how you can sell what we sell our put options, right, to collect premium. And we're looking for the market to come down and fill our order to get long on the market. Well, what we can do is we wait. All right. We don't sell our put option down there and try and get the premium. Now, it's not that you can't. You can certainly sell it down there and have the market come down, and you get a little bit of a drawdown in there, but then the market expires and you get your premium and you get your shares. Or you might not get your shares, right? But the market expires and you get your little small premium. The whole idea here is that we want to wait for the market to come back at the red line. Now, what's been happening a lot to us is we've not been getting our shares, right? Because we're so damn good at predicting market direction because we are good technical analysts. And we kind of put our put options at very opportune times to collect premium, but we never get our shares because we've been so good at predicting where the market's going to go. We don't ever get assigned our shares, and we need to get assigned the shares because that's where you make all the money. You make the money on the rebound and the rise of the cost. Because look at this. This is where all the money comes in right here. Look at that. That would have been, if we'd have got assigned the shares right there, we'd have made $2,168 on the rebound. But instead, we made a measly $165 on the consolation prize of selling of the put option that never gave us our shares. Had it given us our shares and rallied with our shares, we'd have made $2,000. But again, we've been so good at predicting market direction, we haven't ever got. So we've been doing what I call self-assignment, right? Self-assignment means that if the market comes down and hits our position and starts to run away from us, we sell out our limit, or we sell out our put option that we sold, take the premium that we get, our little tiny premium, and then we self-assign ourselves some shares because we didn't get assigned. So we have to self-assign. Well, better than buying 100 shares, which would be 100 at this point down here, this red line would be $15,783. Well, that's kind of tough to get, come up with 15 grand, especially if you got a small account. Well, you can self-assign with a synthetic long. And a synthetic long is just, all you're going to do is buy a call and you're going to sell a put at the same exact price. And you're going to do it at that red line. You want to do it right around that red line. Why? Because that's the delta cone of probability, right? And that's where the market likes to go back to. So you want to do it somewhere right down in that delta cone of probability. And you can see right there, that market came right down into here. That's where we should have, we had our premium. We collected some, couple bucks off of an option we sold, big whoopee grunt, right? what we want to do is we want to make that $2,000 rebound, but we didn't get assigned, so we have to self-assign. And I say it's better to self-assign with a synthetic long than it is to self-assign with 100 shares. If you self-assign with 100 shares, yes, you have an advantage of the fact that you have a longer time period for it to work. You can sell your covered call. If the covered call, if the covered call goes, if the market goes in past your covered call, you can liquidate the covered call and then cover it with some of the shares. You can take some shares off like we did yesterday, right? We took like 20 or 30 shares off, which covered the drawdown on our premium. Or you could roll. You could roll if you wanted to, but it's nice to be able to take those off with the shares. That's one of the advantages of having shares. But you have to have $16,000 to do that. If you don't want to put out $16,000, do it with a synthetic long. This is a synthetic long. And now that we got a synthetic long in here, we can come in here and sell a call against it. So we can come in, drop a call in there. Call, Lan, call. Let's drop a call. We're going to sell a call. Just Broadcom, sell a call up here. We're not 100 days though. We only want to do like short-term days. We like 30 days. 37 is good enough. Come in here. We're going to go sell a call up in here. And now we're going to collect, look at that, $445, $400 to $395. Where do we think that market's going to go? Well, usually we go, 10% out. So we'll go out here. We'll just say an even, where can we get $500? There's an even $500. Let's go a little farther out. Let's go $395. Let's go $400 right there. That's good. So if that market goes up there, we're going to collect $395. And on our very first sold call, we're going to pay the cost of that premium, which was $125. Now, yes, if the market flushes, it's going to lose money just like it was shares. But we didn't have to pay $15,000 or $17,000 to do it. We only had to pay $125. And our very first call is going to pay for it. So that's why I like synthetic longs. And those are pretty cool too. But I like to assign them. I like to self-assign those down here in the Fibonacci sweet spot or down here in the Delta Cona probability, not way up here where we're trying to break a previous high. You know me, I don't like to buy on a break above a previous high. But I wanted to teach you this lesson, so there you go. That is a synthetic long. Now, let's go look at some other charts. Now that we spent an hour on 4 charts, I think you've got the lesson down, right? So now you understand what we're doing here. We got 3 options. We can go with shares, we can go with long calls, or we can go with a synthetic long. And on all 3 of those, we can sell covered calls against them and collect premium, and we can make good money, all right? Rich, rich, rich beyond our wildest dreams. That's how you do it. So now we're going to come in here and we're going to go, let's go to Alibaba. Now, what did we do here? We sold these 3. Oh, okay. So we went long here with a synthetic long. So we have a buy call. So we synthetic longed right here, not on the big green day, but on the next day after. Don't like to do it on the big green day. If you get a big rally like that, it oftentimes pulls back like this. And then sometimes it takes off on that little bar the next day, but it's fallen back again today. That's not good. So anyway, we got in here with the synthetic long. And I put the synthetic long down here. You see that we paid $4,620 and we received only $528. We sold the put against there. But this is a kind of reducing this is more like a poor man's covered call where we sold some premium to help us pay for the long call. And then because we have 3, right? We have 3 of them. I put in a laddered, I like to call them stacked, but we put in a laddered covered call. So we collect 104, 102, and 99. That's weird. Sold a call up higher for more money. Why did it do that? Received 99, and that was closer to the money. That should have been more money. That's kind of a weird thing. What did I do wrong? I must have done something wrong. Sell a call. Oh, I sold the call. No, that's a covered call. Sell a call. That's right. It's just kind of a weird turn of events. Why did it do that? I'm a little perplexed. I received more money farther away. Oh, I went further out. Okay, that's why. This one, I have 9 days. That's why it's only 99. This one I have 23 days, which is 102, and this one I have 37 days, which is 104. So I was like, man, it's further out of the money. Why am I making more money? Well, because I got more time. So that's how that turned out. Okay, so we're good. So that's that name of the game. Now this is our poor man's covered call. It's down $553 because we bought it right there, and the market's coming against us. Yeah. When you have 300 shares, and that's what that's mimicking is 300 shares, we thought maybe this thing would turn around and go, but it ain't. That ain't going. All right, we'll see what happens. We have to watch that one. Okay, Delta Airlines. What have we got going on Delta Airlines? This is our next Darvas box. So we got a call option up here. We sold, and this is a long, we bought a put. We bought a put and sold a call. Oh, we're very bearish on this market. We think Delta Airlines is going to fall. And it's only fallen enough to give us $33. We'll just hang on to it and see if it falls. If it doesn't fall, well, no harm, no foul. Go to Dell. Oh, look at Dell. Dell. Let's turn on the bulls and bears just for fun to see what that is. Oh my gosh, look at that. 4-drive pattern. That's rare. Okay, drive 1, drive 2, drive 3, drive 4. That was a 4-drive pattern. That's a unicorn. Very rare. Don't get those very often, especially not in an individual stock. We might get them more in indexes. A little bit more common, but to see that in an individual stock is very rare. So let's delete all our drawing tools. Let's turn off the bulls and bears again. Where's our Fibonacci? Where's our delta Kona probability? Let's bring this in here. So if we go into our delta Kona probability, Fibonacci ruler, we're right dead center right now. So we're right dead center of the Kona probability. So again, imagine, if you will, that's where the likelihood of the market going to is this one standard deviation, which is what these Fibonacci rulers are. Fibonacci ruler is the one standard deviation from high to low. So that's what that is, and that's where we're at. We're dead center, right at the 50% level. Came right back into that Kona probability. What do you want to do, Lan? Well, we sold a call right here, so we should pick up some shares right here. That would be a good place to own some shares. I would wait. I'd like to buy a synthetic long, but not yet. Let's buy a call. We buy it. See, if we do it down here and we sell our put, we're going to get a skew. What's the pay $843 for that? I think I'll wait because it looks like it's coming down some more. It may come down to 61.8 to the bottom of that delta cone. We've already got 100 shares right here. That's what that means. If that gets assigned, we could have 100 shares right there. We could come in here and rather than do it this way, let's kill that. We could just come in here and sell another put. This is dollar cost average us in, but we'd only want to do, that's 9 days. We could do 37 days and sell a put down here at 61.8. That'd collect $221. And then if the market came down here, we could get assigned there. If it comes down and touches it, starts to rally, we'll self-assign. But we got to self-assign a lot more quickly. We can't wait for the market to go. Otherwise, our skew is too big. So we got to be mindful of this and be careful and keep on top of it and self-assign. If this thing turns and starts to rally and goes away without us and we don't get assigned our shares, because we're not going to get assigned as shares until closer to the purple line. And if the market comes down, turn starts to rally, we're going to have to self-assign. And we're going to do that with a synthetic long instead of $11,000 in shares. This one here, we're going to do. This one, we might get assigned some shares. If we do, we'll be able to sell a call against it. But this is our Darvas box. So we got a Darvas box going from here to here. Well, it's got to break above that. So we don't know where that Darvas box is going to end, where it's going to go and break up into the next one. And we don't want it to come down and break out the bottom of the Darvis box. That's no fun. And we got to draw our trend line in here. Just like that. Okay, let's do it like this. I'm going to show you another little trick. We're going to come in here, go to the preferences. I'm going to go extend trend line. Just like that. So we go right off of that first triangle. And that's your triangle. So that's our geometry, right? Now our next geometrical triangle is right here. Okay. And then our next geometrical triangle is right here. And that broke right there. And then we went into another geometrical triangle right here. And then we went into another one right up in here. That's crazy. And then, of course, it flushed all the way down here. So we'll just draw that off in there. But bulls and bears, which is our tuned indicator, it said this is, so it did break. See, it broke right there. But I'm going to just combine that one into one. So it says 1, 2, 3, 4, technically 5, just like, well, that's what that is right there. That's the fifth. Man, 1, 2, 3, 4, 5. That's unreal. Well, it is what it is. You got to just take the good with the bad. That was crazy. That's nice. And now we're going to have to redraw our, see, we started to lose strength up in here. So let's go to this one here and then shoot off our little, and then we got strength again. Then it started to gain strength again. So we went to there. So that's our spider web. That's our spider web. It's kind of an ugly one. That's an ugly spider web. Man, that's an ugly spider web. But that's what it is. It is what it is. But that was an ugly market. It went 1, 2, 3, 4, 5 drives before it flushed. Man, that's a strong market, Dell. That's what I have. I have a Dell computer. I always tell everybody when we're in class, like, I need to buy a new computer, Lan. What would you recommend? I always buy the Dell XPS, and the most expensive one I can afford. Most expensive Dell XPS they have. That's what you want, because that thing's going to last you 10 years. So by the time 10 years comes along, you're glad you bought the most expensive one, because then it's the lowest bottom of the rung by the time 10 years comes. These things last forever. They're really good computers. All right, what are we going to do here? We're going to get into this baby, man. Dell is a good company. We're going to get into it. They're about the only one left out there making laptops. That's not true, Lan. There's all kinds of companies that make laptops. I know, but none of them can compete against Dell. Dell is a really good company. All right, you know the story of Dell? Michael Dell. He started that. He was in college when he started the Dell company, and he was yeah, I remember seeing pictures of him stacking computers, laptops in bathtubs. In the bathtub at his dorm room. That's where he stored them. And he started the Dell company in the dorm room of his college when he was in college. Crazy, right? All right, there we go. I guess there's not much else to look at on here. We got to go a little faster. So we're getting a little rise in this market. We got a little triangle going on. We're long. What do we do? We're making $74. I don't know. We got to move through these things. We're long this one here with how many share? Long 3. What? We're only 3? Oh, well, they're $430 a piece. Let's just come in here and put a stop at break even. All right. Then just let that baby run. Run, baby, run. All right. Johnson & Johnson. Oh, my gosh. Look at Johnson & Johnson. 3 drive pattern on the way down. Drive 1, counter trend. Drive 2, counter trend. Drive 3. Holy smokes. What is wrong with this company? Look at this Darvis box. We're going to go all the way from here to here. What the heck? This thing has just stayed flat in this thing. Oh my gosh, look at this. Technically speaking, that Darvis box is that long. No way. You're going to have to break that Darvis box down into a bunch of smaller Darvis boxes, even though it just went flat through that whole sideways thing. My gosh, look at that. Quit doing that auto scale bullshit. I turned you off. Okay, here we go. Look at this thing. It has stayed inside of that box the whole time. What do you think it's going to do when it gets down here to the bottom of that box? Let's go look and see what's going on with this company. What the heck is going on with Johnson and Johnson? What's the symbol? J&J, right? J&J. Well, I think Johnson Johnson they pay a really good dividend. Well, it's subjective to say it is $1.24 every quarter is a really good dividend. And so a lot of people trade Johnson Johnson just for the dividends. They just hold on to them. But you got to be mindful of you got to be mindful when you trade for dividends. You got to be mindful of the NAV, the net asset value of the stock, because dividends, especially on a stock like this, they're not gonna the NAV is going to lose way more than the dividends are going to cover. So you got to be very careful. You want to make sure that if you're going to do that, you buy low, sell high. I mean, buy down here in these lower regions and continue the dollar cost average into your position. You want that NAV to be as low as you can get it. That's why you set your boundary, and you only buy if it's below your average cost, right? The dollar cost average in. So let's go back over here just real quick and show you. If we just take a dollar calculator and go from here to here on 100 shares, that's $2,000. Your dividend is not going to cover that. All right. It'd be your $2,000. This is where you'd be looking for the dividend to cover it all the way down here. That's a $2,000 loss. Your dividends are not going to cover that. They'd help. I mean, they would help, which is why we put these. This is one. I think this is one that's in our Richie Rich fund. But also notice it's only pays out the dividends quarterly, not monthly. So we like monthly dividends if we can get them, but quarterly at over $1, that's pretty good on Johnson & Johnson, you got to admit. But now is a good time to start loading up on this thing down here in this as it approaches this lower region. That would be wow. This is a crazy market. Johnson & Johnson just really doesn't move that much. It stays in that. It just stays there. Go get those dividends. So let's start buying this thing up. Let's come in here. Of course, we only want the dividends if we got good NAV, right? Don't get blinded by dividends. If you don't have good NAV, you don't want the dividends. Okay, so let's come in here. And let's put 37 and sell another put out here. We sell it right at, okay, that's close to the money I get. That's $197. That would be good to have. You could do that. Let's do that one right now. We'll put this in here. It's coming towards us. So that's going to be implied volatility. Let's go look at the options chain. Implied volatility. Well, look how low it is. It's only at 15. And it's coming towards us. So that's a big, fat, juicy premium. Because look at the theoretical value. It's valued at $157 and it's currently at 203. So by doing this, you're getting good premium, and you got the opportunity to pick up some shares down here at the bottom of this Darvis box and start collecting some dividends. So that's if you're a dividend hunter, that's not such a bad trade right there. Let's go ahead and mark it into that. JP Morgan. What did we do here? We sold a call, so we are short the market. We're up $200 and it's still falling. So that's good. The market. That's what that sold the call. We didn't buy the call. We sold the call, which means that market's falling and we make money when the market falls. And so we're making money as the market falls. We can come in here and spend another 20 minutes analyzing this thing, but I'm kind of running out of time with you guys. I have to do this. You have to do all this on your own. There we go. There's our target part, our first target right there. Of course, you can see Fibonacci sweet spot, delta cone of probability off the top to the bottom. And we're going to bring that back here. We could go all the way back here and get a big cone. Well, we got several Darvis boxes in there. Let's go off a less aggressive one. Well, that's where this one's at right now. So right here, Fibonacci sweet spot. That's the delta Kona probability right there. It says that that market's going to come back down in here. That's where we want to be a buyer of JP Morgan, down in here. Land, sell a put, collect some premium. No, let's wait for it to get down there. We'll get some really fat ones. Well, you could do one right now, get some skinny ones. Yeah, but then we just go through a big drawdown. Yeah, but it's almost there. Yeah, there's probably not enough money in it to do it. Let's try it. Okay, we'll go look at it. 37 days, sell a put. $257. That's not bad, but look, there's your expiration way out there. If we put it here, it's $168. I guess you could do it if you wanted to. $169 better than a stick in the eye. I like to wait for the market to come down there and sell it at the money. Well, in the meantime, why don't you sell one and pick up $256? What's that going to hurt you? Well, it's not. 168. We could put one there. All right. We'll do that then. That's what you want to do. I generally like to wait. I want to wait for it to come down there and sell it at the money. That'd be $500, $600, $700. Do it now. Well, well, what if it just turns and bounce off that green line, starts going up? Then you miss your $255. All right, okay. I get your argument. I get it. I understand it. Let's go ahead and get into it then. Let's get into her. Get her in. Get her going. All right. What's McDonald's going? Ooh, sell a put. We need to self-assign on this. Actually, does that look like it's going to start going back up? Look at that Darvis box. Look at that drive. All the way up that big old thing. And then drive 1, drive 2, A, B, C down. We're getting a little head and shoulders formation in here. Look at this. This is your left shoulder. That's your neckline. That's your head. There's another neckline. There's a right shoulder. And then that is there's your buy signal. Now, the question is this thing going to keep going up, or at least this way, and not going to do this? McDonald's is your kind of place. French fries between your toes. Pickles up your nose. Oh, wait, I think it's French fries up your nose. Pickles between your toes, right? Okay, let's see. What do you want to do, Lan? Well, you got a position there. You're trying to collect some premium, $430. You're up $273 on that one. You could wait to see if you're going to get assigned. I know, but McDonald's, I might want to self-assign right now. What if that thing goes off that head and shoulders? What if it pulls back? You'll lose money. What if it comes all the way back down to the red line? It's scary. That's scary. I don't want to make a decision. That's a buy signal, though, Lan. That's a buy signal. Why don't you do that fancy synthetic long right there? And then sell a call against it. That's a good idea. Of course it's a good idea. Let's come in here and do 100. We will buy a call and we will sell a put. That's a synthetic long that's going to cost us $195. And then we're going to come in here. Do you think we can do it all in one ticket? Let's try it. $37, and we're going to sell a call up here. See if it'll let us do this all on one ticket. No, that's only $104. 175. Well, I guess it's better than a stick in the eye. Okay, we'll do the $104 one. There, we pay $94 for that thing. Yeah, let us do it. All right, we'll try it. We self-assigned to the long position. We didn't get our assignment on this one here, but that's going to pay us. How much is that going to pay us? Let's go into our positions. This thing's going to pay us at $430 if we don't get assigned. That's pretty good. All right. We're very bullish on McDonald's right now. We need this baby to climb. Go buy some Big Macs. Oh, Morgan Stanley didn't load. Microsoft. Man, we're making money hand over fist on Microsoft. What is this one? I think we sold one right at the money. Buy a put. Oh, we bought a put. We're losing. Oh, that was our hedge. We're down $261 on that hedge. It's got 9 days left. Still got $169 in it. Let's kill that one. That hedge didn't work. They were still long, 47 shares from here. Man, Microsoft. That thing's got some wheels under it. Look at that nice little natural trend line right up there. Broke that thing, drive 1, drive 2, drive 3. Just like a train on rails, and now it's going to the next drive. See that? Boom, boom, boom. Do your geometry. Do your geometry. Your geometry teacher would be so proud of you. I didn't take geometry, Lan. Well, now you came to my class and you just took your geometry class. There you go. Geometry is just triangles. So if we're going to get another geometrical pattern, we'd look for a triangle, right? How bad is that thing going to come back? I don't think it's going to come back all the way down to that pattern there. That would be a big flush. So that would come in here off of this low to this low, and then we come in and we do our laser beam like that. That would bring that all the way back there. I don't think that's going to happen. I think we're going to get a new something in here like this. Let's just do it right dead center through the dead center of that triangle. So we get that triangle there. I don't think it's going to come back all the way to here. Oh, come on. Quit fiddling with me. So I think that's going to come back at least to there. We'll put this one back where it belongs. What do you guys think? That's why I put a short in there. But man, this thing's got wheels. Look at it go. Where's the Darvis box, Lan? Well, the break of the previous high is the top of a Darvis box, right? To go into the next Darvis box. But the thing is we had this full. The other thing is that we put an Elliott wave inside each Darvis box. And so we finished out the Elliott wave. The Elliott wave actually ended up here. So if we bring this Darvis box down to there, we're in the new Darvis box right now. So we just went into the new Darvis box right there. So if we take this Darvis box, we just bring it right back to here. Actually, we'll start it right there. So now if we take this Darvis box and go from here to here, up to there, that's the next Darvis box. Now the previous high is up here. Don't forget that because that's an important point. Dead center of that next Darvis box. Get off. Okay, so we need an opportunity to buy some more shares. And if we do that, where are we going to buy those shares? I think I would want to buy those shares as it came down here. Now we put that triangle, or we put that line right there because that was the dead center of that triangle. Let's send that one to the back. Bring this one forward and put what? This one here. See, that's that line right there. But I don't think, because I'm a little bit more bullish on this market, I just put it dead center between those two. I think it's going to come back to here. So if it does that, how do you want to make money off it, Lan? Make money. Okay, we'll sell a put right here. So if it comes back, we could get assigned, and that's $400. And we could get some more, another 100 shares of Apple. That's $300. Microsoft. I would buy some more, 100 more shares right here. If it would pull back to this, you want to buy them there, or you want to buy them down a little bit more right there? That's $300. But I want that $400. But right in here. Yeah, we'll do that. And then if it pulls back, we'll buy another 100 shares right there. We're running out of money. That's what we want to see. Getting all of our money in. Then we got NVIDIA. We got O'Reilly. Uh-oh. We sold a put here and we're getting our hiney handed to us on O'Reilly. Let's go ahead and what's that? Let's just liquidate that baby. Out of here. All right. Semiconductor, making money, Pepsi. Oh, we might get assigned some shares on Pepsi. We get a margin call because we don't have any money left. Palantir. Palantir's flushing. We sold a put here. We buy some. That's what that's saying. It says we'll buy some Palantir way back here if it'll come down there. We'll buy 100. It's not too much. $6,000. All right. Not getting very much money out of them. Charles Schwab sold a put here. Why did we sell a put there? Why in the hell would we sell a put there? I don't know what we were thinking. I don't know what we were thinking on that one. Take that baby off. Look at this thing rocketed straight up. 3 drives. That almost looks like 2 drives, doesn't it? 2 big long drives. Drive 1. Drive 2. Maybe that's why we bought that put. So we're going into a 3rd drive. I don't know. Look at this high back in here. Busted through that. That's where our yellow line's at right now. And then we got this high back in here. Using that as support. This might be going into another Darvis box. That might have been why we did it. We're like, hey. But we're at the top of the 2nd drive, which is a breaking above here. That would be this long-term Darvis box back here if we wanted to draw that all the way back there. But I think that would have to start a new Darvis box. We'd have to go back in time and spend more time analyzing this market. But if we did that, that would be the end of that Darvis box right there. But that's only 2 drives. Look at that thing. It's going into a 2nd drive. We're going into a 3rd drive right here. I think we'd probably get a little bit of a profit taking in here and then go back up. And then that would be this Darvis box here. So we could draw another one in here. Man, this video is getting really long. So who cares? We're here making money. All right. Teradyne. Well, we're making money hand over fist on Teradyne. We should have self-assigned down here. Daggone it. We put our order in there and we didn't get assigned. All we got out of this rotten little run. I thought we'd get a little bit better of a pullback on that. We didn't. It just took off. Now I'm long Teradyne in my real money account. I've got some. Why didn't we do it here then? So I was just trying to get assigned. I wanted to get assigned. We should have self-assigned. Because if we would have self-assigned, look, from here up, that's $1,700. That's why you got to self-assign. If you're too good at predicting market direction, and we put our orders in there, and we don't get assigned, we miss out on all that money on those rebounds. We got to start self-assigning. Synthetic long would have been good right there. Yeah, nothing left in there. $25 is all there is left. You leave it on there. Do we need the money? We don't need the money. $25. We got 100 out of the 125. 25 is all that's left. Mark comes down. It's not going to come all the way down to there, but we could just take that off, free up some cash. All right. Well, we'll stare at Teradyne. Let's see if we can get an ABC pattern out of it. So come up. We'll look for it and pull back a little bit and then up again. I don't know. Let's just wait on that one. Go to Texas Instruments. Oh, it's coming down way farther than I thought we would. Look at that. We got this one here. We're going to get signed way up there. There's 9 days left. Looks like it's going to turn around and start to go back up, though. We could get assigned there. I wouldn't feel bad getting assigned there. We could roll it. Let's see if we could roll it just for fun. Let's roll it down. Let's roll it down too. Pay $330 to roll that thing down. But if we rolled it, they're less likely to get, well, depends on if the market keeps going down. That's 9 days. Pay $330 to roll it down and keep the same amount of days. If you extend the days, oh, well, that would be extending it, 37. Oh, no, it says 9. Let's extend that to 37. Now we receive $62, so that's a credit to roll it. Let's roll it down farther. We'd pay $180 to roll it down to there. But then there's less likely chance we could get assigned. We might have to self-assign. But that's going to pay $180. No reason to pay money. Go there and we receive $70 more. That's just rolling it down one. That doesn't look right. It says 9 days out here. Let's try that again. Oh, we got 2 of them in here. That's why. What is this? Sell a put, sell a put. Oh, we got to cancel that. Let's just wait and see if we get assigned on that, just for fun. I don't want to. We could roll it. But if we roll it, there's a chance that market could rebound. We wouldn't get assigned. We'd be mad again. Doggone it, why didn't we get assigned? Let's just wait for a minute. ExxonMobil. Holy cow! ExxonMobil flashed. We knew it was going to do that, though, didn't we? We were like, why in the hell would anybody go long on oil, knowing that Donald Trump's going to get in there and open the spigots? Man, that thing is killing us. Killing us. We're dying here. We're dying here. What are you going to do? You could just liquidate it and take the lumps, or we could roll it. We'd have to roll it out. We're already, oh no, 37 days. Let's try and roll it down. Let's go roll down. Let's see, roll the option, roll it down. Let's see, roll it down there. Ooh, we rolled it all the way down to here. We got to go farther out. How many days? 37. It cost us $100 to roll it down there. What if we roll it down? Wait a second. Oh, we have to roll it all the way down here. Then we'd pay $368 to roll that out. That's no good. I think we're just going to have to take our lumps on this one. I don't want to own the shares way up there. We weren't paying much attention to that. Let's liquidate. Let's just take our hit. Just take our hit. I don't know. There's a nice strong area of support way down here. If we were to come in here and sell another put, 37 days out, sell a put way down here, that would be $216. I'm going to wait on that. We could have done that just as we rolled. That's a roll. We close that one out and put another one on. Let's wait, see if it comes down there a little bit. I don't know. What if it comes down here and turns and goes up? We're going to be so pissed off. Let's wait for a minute and see what happens. I don't know. Feel bad on this one. Just don't know what to do. Don't do anything. We'll wait. Texas Instruments, another one. We're just going to wait on, see what happens. Look at this way down here. Way down there, $214. 37 days out. All right, guys, I guess that's it. I do have a little Sunday school lesson for you. Let's talk about you. What are your financial goals and aspirations? Who wants change? Everybody raises their hands. Who wants to change? Nobody raises their hands. How are you going to reach your goals? If I were to ask you, where do you want to be in 12 months from now when it comes to your trading? How would you answer that question? What are you willing to do to achieve that goal? I love seeing you guys come here and spend an hour and a half with me in the morning, analyzing charts, looking at things, learning. It's a great way to learn. Spend some time with somebody that does it all the time. Get exposed to it. There's no better way to learn than just come and hang out, learn, see what we do, see how markets go. If you don't adopt all my strategies, that's fine. Build your own. I mean, you just take what you learned from me, take what you learned from other people, hang out, look at that, do your charts, learn. That's the way you make money. You just learn, and nobody's ever perfect. We don't know what to do all the time. Sometimes we don't know what to do, and so we don't do anything. Sometimes not doing anything is a strategy too. Let's come in and say hi to a few people. John C. coming in. Very first this morning. It's nice to see you, John, coming in with the gold. We got Bruce coming in with the silver. Bruce, and then we got Kirk coming in with the bronze. Nice to see you guys first thing in the morning. And we got Frosty down here. It's nice to see you guys at least saying hello. We got a bunch more watching than what are saying hello. So if you guys want to throw your marquees up there next time, we'll make you famous. But it's good to see you guys. Glad you came and hung out with me. Hope you're learning something. And we'll catch you tomorrow for Power Hour. I promised that we were going to do autopilot on Power Hour. And then I also promised that we were going to do some more Minesweeper on Power Hour. We've been testing David Duty's strategy a little bit with some of those jump stops and things. But got a little wild and crazy yesterday. But we'll try to be a little bit more calm and approached on tomorrow for Power Hour. So come and hang out with us Power Hour. Power Hour starts at 1 o'clock. 1 o'clock Mountain Time. That's my time. And of course, that's 3 o'clock Eastern Time. So do the conversion for wherever you live. Come and join me tomorrow, and maybe we'll play with autopilot. All right. I promised we'd do a little autopilot. So buy the arrows, Land. Just buy the arrows. Yeah, buying the arrows, good strategy, but you know what? Then we have to just sit there and do nothing for half an hour waiting for an arrow to show up, and that's no fun. So we'll do scalp and trail. We'll do a little bit of both. So we'll turn on the autopilot, let it take the arrows, and then we'll do some Minesweeper for some short-term scalps. All right. How's that sound tomorrow for Power Hour? Let's do that. That sounds fun. We'll see you then. All right. Take care. Have a good evening.